Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your daily technical analysis of foreign exchange markets.
Euro-dollar. A third bullish white soldier yesterday after the recent bullish harami. Prices are testing higher, though very sluggish, as they sit at or just underneath the significant overhead resistance from the combination of the 50% Fibonacci line of the January 21 to September 22 move, currently at 109.44, and the shallow dark blue neckline of the July 17, November 18 head and shoulders pattern, also currently at 109.44. A little beyond this is the purple neckline, currently 110.17 of the January to February 2021 reverse head and shoulders neckline. Now this neckline is just the start of overhead congestion and resistances stretching up to the July 2023 high at 112.76. As I said recently, I would continue to keep an eye overhead at the September 2024 high at 112.13. You see, if prices exceed that, then we have set up the conditions for this market to make that rarest of patterns a possible annual key reversal. However, a number of significant resistances ahead of that, starting with this 50% Fibonacci line and the shallow dark blue neckline. And the 50% Fibonacci line had previously capped a reactionary rise back in November last year. Now, so far today, capped once again by the neckline and 50% Fibonacci combination, and looking like a bearish opening black Maribosa right now. Cable, aka sterling against the US dollar. A possible higher indecisive spinning top yesterday. It was the highest high and highest close since November last year. Overhead, we still have the secondary hard to reach target X1 up at 131 even for the breakout from the recent dark blue ascending wedge pattern. In the way, we have the November 2024 high at 130.47, whilst below we have the November 2020 low at 128.52, which acted as support early last week. And then the flatlining gold long moving average below that, which is currently 127.95. As I had said recently, I would continue to keep an eye overhead at the September 2024 high at 134.34. You see, if prices exceed that, then we have set up the conditions for this market to make that rarest of patterns a possible annual key reversal. However, we have a number of significant resistances ahead of that, starting with the low of December 2020 and the high of July 23 at 131.33 and 131.44 respectively. Now, so far today, a small reactionary move back down, but still within yesterday's range. US dollar against the Japanese yen. A long and interesting commentary here. An indecisive doji cross yesterday, though with a long tongue on top. This after the previous session's bullish opening white Maribosa. Prices pierced the immediate overhead resistance, which is the 50% Fibonacci line, the July 23 to July 24 move, at 149.61, but failed to close over it. Beyond this, we next have the next 50% Fibonacci line, the one for the whole of 2024, at 150.76. Overall, the market is countering some of the more recent bearish patterns, whilst remaining within the larger one, the big picture item, the bright red July 24 to January 25 bearish Andrews pitchfork. Now this pitchfork shows the bearish angle of attack of this market as prices head lower, and we are right now in between the overhead upper time, currently at 152.42, and the middle time below, currently at 137.13. However, we are seeing some hesitation in the smaller near-term bearish patterns. The oft-mentioned early December 24 to late February 25 rounded top pattern. We have formed the rounded top itself and started the exploitation of the downside, but we are now hesitating. The primary target area for this pattern was reached, but the secondary, much harder to reach potential, in this case, much harder to reach potential, is down in the 138.40 zone. I've taken the decision for now not to assign it as a target because, after all, it is so far down below the 2024 low in September and would bring up all sorts of questions if that happened. Now, the primary question would be if we would form a very rare annual key reversal down here. In the meantime, we have another more immediate pattern here, highlighted in pink on my daily chart. An early February to date descending wedge pattern, currently 145.13 to 147.98. This pattern had been the very recent driver lower and helped the rounded top reach its primary target. However, this past Monday, we had a first close over the upper trend line of this pattern, which has since been exploited. Thus, I've laid out some potentials for this break higher out of the descending wedge pattern of a primary target X in the 153.59 area and a secondary harder to reach target X1 up in the 156.68 area. Both of these targets are outside the bright red bearish Andrews pitchfork and may raise questions as to whether or not to finesse the bright red Andrews pitchfork into a shallower bearish shift pitchfork. Now, so far today, a push higher over the 50% Fibonacci line at 149.61, but not by far, and prices still seem reluctant to stabilize higher right now. US dollar against the CNH, the offshore Chinese yuan. An indecisive spinning top yesterday with an interesting tail on it, after the previous session's bearish closing black Mariposa. Now the tail dropped down to touch and swiftly react back upwards from the flatlining gold long moving average, currently at 721.95. Overall, we are still within the January to March 2025 descending wedge pattern, currently 721.15 to 727.75, though I think the gold long moving average may be standing in as a proxy for the lower trend line. We're also still within the breach, but now seemingly repaired late December 24 to late January 25 bearish Andrews pitchfork, in between the overhead upper time, currently at 725.57, and the middle time below, currently 717.99. This bright green bearish Andrews pitchfork is, along with the descending wedge pattern, the current showrunners of the market, and thus still puts at risk below the gold long moving average as well as the May 2020 high at 719.64 and even the bright green middle time. Overall, there continues to be the possibility of looking at the whole late November 2024 today action as a possible double top, even Adam type. On this pattern, I would continue watching very carefully the market's actions and responses on any approach to the gold long moving average below. Now, so far today, a reactionary move back up after yesterday's test and rejection of the gold long moving average below. US dollar against the Brazilian real. A lower but indecisive spinning top yesterday as the market made a new low, one not seen since November last year. It has also set up the conditions with over a week left to go for a possible monthly key reversal down in March. Thus, if we close on Friday the 31st of March, either over 591.77 or under 567.49, then we'd be on. Anything in between and would have the lesser outside month pattern. At the moment we're edging just a bit towards a monthly key reversal down. However, the more immediate actions have been this week's exploitation of the move down below both the bright red May 24 to March 25 uptrend, currently at 579.77, and the now flatlining gold long moving average, currently 573.29. These two, the bright red uptrend and the slowly rising gold long moving average, that's currently at 572.85. Should it be 570? It's been moving around a bit there. So the latest we've got on that is 573.29. So let's say 573.29. Well, it had been guiding prices higher now for 4 weeks, yet the top side had also been capped by the bearish pressures from the March 21 high at 588.04, and especially capped by the mid-December 2024 to date dark blue downtrend, currently at 580.37. Now looking below, we have a lesser 38.2% Fibonacci at 565.07, which is a gateway to congestion from June to October last year, between roughly 565.07 down to the flatlining neckline of the June to September last year head and shoulders continuation pattern, currently 540.45. There are not many defined support lines really until about dropping under the 545 even level. Finally, we still have below target X in the 563.35 zone and the harder secondary target X1 down in the 541.95 zone. These are the primary and secondary targets for the drop down from the large early October 24 to mid-January 25 rising expanding wedge pattern, and these targets are still live. US dollar against the Mexican peso. An interesting gravestone doji and possible shooting star pattern yesterday, a pattern that's usually seen as bearish, though there is a bullish variety of it. This after the previous session's indecisive doji cross. All this activity, or should I say pattern creation activity, is hardly surprising as we have A, stabilized under the bright red lower bull channel line of the very gently rising early November 24 to early March 25 bull channel, currently at 20.3033 to 21.0734, and that has become B, a rectangle top pattern. Now last Friday the market reached down to target X at 1985 even. That's the primary target for this pattern, but we still have open the secondary harder to reach target X1 down at 1948.90. However, last Friday's and this week's action so far has also shown off a significant support below the previously highlighted congestion zone between 1987.96 to 1991.31. It's quite narrow. Prices have indeed punched down through this congestion, but we've so far ended up closing right on top of it or right in it. Further down we have the April 2022 low at 1971.68, and that is just above the flatlining gold long moving average, currently at 1970.28. So far today a small dip and reactionary move back up. I'm beginning to wonder if we are seeing a very small basing action right now on top of the congestion between 1987.96 to 1991.31.
Thank you for listening. This short version broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.